say that it's probably, I would say, quite a difficult question. And there's quite a lot of, it brings together two things that I don't think I've ever seen brought together before in a question. I mean, I've been looking at these, not just AIA, but all the professional bodies questions for years and years and years now. And I don't think I've seen a question quite like this one. So I wouldn't be surprised that people, I think people did find it to be quite a difficult question. So it brings together two very different topics. The first is that of independence and ethics, and the second topic is IFRS 2. And, you know, you wouldn't have expected, I certainly wouldn't have expected to see those two questions brought together in the one, those two topics brought together in the one question. What I'm going to do is I'm going to have a look, first of all, I'm going to just do an overview of independence and ethics, and then I'm going to do an overview of IFRS 2, and then we'll have a look at the question. So, on the whole question of independence and so on, and the whole question of ethics, I suppose it's fair to say that there's two ways that you could go about ensuring that auditors stay independent. And one is what they call a conceptual framework, and one is what they call a rules-based approach. And very, very broadly, you could say that in the UK and in countries that follow a sort of a UK legal model, we tend to use a conceptual approach, whereas in the US they tend to use more of a rules-based approach. Now, the idea behind a conceptual approach is that auditors are required to identify threats that may compromise ethical behaviour and, when necessary, apply safeguards to eliminate or reduce the threats. Now, these words like threats and safeguards are very important because these are the words that are used in the standards, and hence they are the words that you would be expected to use in the examination. It requires active consideration of issues and can be applied to different circumstances. So the idea here is that you are supposed to be actively considering independence and potential threats to independence. So you're meant to be giving active consideration to these things. You're meant to be continuously considering the implications of things that are happening. It requires judgment rather than a literal interpretation, which might be encouraged by a pure rules-based approach. So you're expected to apply professional judgment. But in certain situations, the conceptual framework approach will prohibit the accountant from entering into certain services because there will be no safeguards available to sufficiently reduce the threats to an acceptable level. In other words, there are still some things you cannot do. There are still some rules that you cannot, certain things you cannot do, or certain rules you must adhere to. The world governing body of accountants is called IFAC, the International Federation of Accountants, and a subcommittee of IFAC is called the IESBA, which is the International Ethical Standards Board for Accountants. And the IESBA produces a code of ethics. And as you can see, it might be a little hard to see it on the screen depending on how far away you're looking at the screen from, but you can download it afterwards. But essentially there are three parts to it. The first part is about the general application of the code. The second part is about accountants in public practice, and the third part is about accountants in business. Now, for the most part, when you're talking about auditors, you're talking about Part A and Part B of the code. You're talking about the general application of the code and the application to accountants in public practice. And you really should know before you go into the examination. You shouldn't go into the examination without knowing, broadly what it says in relation to, I'll be going through Part A in a little more detail in a minute, but also broadly the kind of things that are covered in Part B, which is things like professional appointments, conflicts of interest, second opinions, and so on. Broadly, at least, you need to know, you need to have that in your mind going into the exam, because some of those things some of those things will almost certainly come up. So Part A of the Code establishes the fundamental principles for professional behaviour and the conceptual framework for applying the principles. The next slide, I won't spend too much time on, it's just defining what is meant by a professional accountant, an accountant in public practice, and an accountant in business. And you can look at those definitions, but essentially public practice means that you are providing services to the public, such as auditing services or certain non-auditing services. Now, much more important is the next slide. Let's say that. Yeah. Is this next slide on fundamental principles. Now, basically, what the standard does, what the IESBA code does, is it sets out 5 what it calls fundamental principles, and it basically says, as an accountant, you must adhere to these. Now, 4 of them: integrity, objectivity, professional competence, due care, and professional behaviour. I think it would be very hard to think of a situation in which you didn't have to adhere to those. Certainly, it'd be very hard to think of a situation which you didn't have to act with integrity, in which you didn't have to act with professional competence, in which you didn't have to behave professionally. Objectivity is perhaps a little more difficult in some situations, which we look at. Confidentiality, there is an underlying principle of confidentiality for all work that accountants do. So in general, if you're an accountant, you're expected to keep any information you get in that role confidential. Now, there are some exceptions, and you should know what the exceptions are, but I'm not going to cover them today because they're not relevant to the question that I'm looking at for now. But just be aware that there are some exceptions to the principle of confidentiality, and you do need to know what they are. Now, the next slide, sorry, I'm sure. Over a couple of slides there. Yeah. The next slide, again, I won't spend much time talking about this, but this slide just sets out in a little more detail what is meant by the 5 fundamental principles of integrity, objectivity, professional competence, and due care, confidentiality, and professional behaviour. And again, make sure going into the exam that you're able to write at least a sentence or 2 on each of those. Not absolutely specifically relevant to the question we're doing here, but it's not hard to imagine that it could be. Now, the conceptual framework approach talks about the fact that those are, the basic principles. Well, it says that the basic principles can be threatened by circumstances and relationships that could compromise an accountant's ability to comply with the fundamental principles. So, safeguards or actions or other measures that may eliminate threats or reduce them to an acceptable level. So we have this idea of, here are the principles, here are the threats that could that could cause you not to meet the principles, and here are the safeguards that you put in place in order to ensure that your use of the principles is not threatened, essentially. So the idea is that you should identify threats to compliance with the fundamental principles, evaluate the significance of the threats identified, and apply safeguards where necessary to eliminate the threats or reduce them to an acceptable level. Now, in some situations, applying the safeguard could mean, for example, not accepting a particular client or not accepting particular work from a particular client. Now, obviously, that's a kind of nuclear option, because obviously if you do that too much, you end up with no clients. So you have to strike a balance between being able to accept clients being able to do work for clients, and yet not compromising your independence. Again, this is just setting it up. This talks about the types of safeguards that there are. And basically, it says that there are two types of safeguards, although some textbooks say there are three. But in this particular case, we're talking about two types of safeguards. One is safeguards created by the profession, legislation, or regulation. So in other words, the IESBA doesn't go around making up these standards for the fun of it. It doesn't go around making up these standards just to make life difficult for auditors. It goes around making up these standards to make it easier, if you will, for auditors to act ethically and to act in an ethical manner. Now, the safeguards of the work environment, there are safeguards applicable to accountants in public practice and to those in business. Now, okay, what do we mean by, well, if we go to the next slide for a second, we'll see the kind of thing we mean by safeguards created by the profession, legislation, or regulation. So this is things like, obviously, you have to do exams before you can become an accountant. There's continuing professional development requirements. There's corporate governance regulations. There's professional standards. There's professional or regulatory monitoring and discipline procedures, and so on. Right? So there's a whole raft of things that you are required to do, and they are. Just 1 second. Okay, sorry. Yes, I wanted to go back to this slide for a second because what I wanted to say was those are examples. What you're seeing there are examples of safeguards created by the profession, legislation, or regulation. There can also be safeguards in the work environment. So, for example, some firms will have regulations that are more strict than the regulations that are laid down by the standard-setting body. And firms will have their own protocols around that, and that's what they mean by safeguards in the work environment. Some textbooks also talk, although it's not here, but some textbooks also talk about a third level of safeguards, which is safeguards that arise from one's own personal integrity. So some textbooks also put in there that, you're expected to act as an individual, you're expected to act with integrity, and therefore those safeguards also come into play. And also, of course, there are prohibitions. There are some things that you simply are not allowed to do. Okay, Part B of the code illustrates how the conceptual framework is applied to specific situations by accountants in public practice, and this is one of the things that we want to look at here now. Now, there are about 10 situations here that there are specific rules about, okay? Now, I don't have time to go through them all here today, but again, you should know these. Now, these are very similar to the ones that we were looking at earlier, I think it's called Part B of the IESBA guideline. But there are specific rules about professional appointments, about conflicts of interest, about marketing professional services, about objectivity in relation to all services, about independence in relation to audit and review engagements, about second opinions, about fees and other types of remuneration, about gifts and hospitality, about the custody of clients' assets, and about independence in non-audit engagements. And again, any of this, not all of these obviously are relevant for the particular question I'm looking at today, but any of them could come up in the exam, and you really should, before you go into the exam, make sure that you can, make sure that you know at least a bit about the specific rules in relation to each of these. Now, I will mention, because it is specifically relevant to the question we're going to look at here, the fees and other types of remuneration. That is one of the ones that is particularly regarded as potentially giving rise to a threat to independence, and that is particularly relevant to the question that we're doing today. But it could be any of them in terms of the exam. I'm reading my slow to go forward today. Okay. Now, examples of circumstances and relationships that may create threats to practitioners. Now, I'm not sure if you've lost the anyway. Right, okay, we're back to and yeah. Now, sorry about that. I don't know what happened there. There was a slight break. Examples of circumstances and relationships that may create threats to practitioners. Now, I'm not going to go through all of these, but you should go through all of them before the exam. But I will particularly look at the first one, which is self-interest threats. Right? Now, one of the ones there, the self-interest threat, one particular self-interest threat is the second one there, and this is one that's relevant to the question we're going to have a look at. A firm having undue dependence on total fees from an audit client. And what that principle is telling you is that if you're an accountant in practice, if you're in public practice, you shouldn't be getting an excessive amount of fee income from any one client. Because if you are getting an excessive amount of fee income from any one client, and relationships with that client are not, turn out to be not as good as they might have been, then you may be reluctant to, for example, qualify that client's audit report. So there's potentially an issue there. Now, what does undue dependence mean? Well, the normal rule in relation to undue dependence, the IESBA standard doesn't mention a particular figure, but the APB, which operates in the UK and Ireland, mentions a figure of 15% of your gross recurring fee income. So for any particular practice, what they say is that you shouldn't get more than 15% of your gross recurring fee income from any client. Now that's all the fee income you get from the client divided by all of the fee income that the practice gets. So it's not just the audit fee, it's all the fee income from the client divided by all the practice income. And as you can see, that's only one of a number of things that are there. Another one that might possibly be relevant is another one that might possibly be relevant there is what they call a familiarity threat. That what this is saying is that you shouldn't become too familiar with an audit client. Now, this again is a delicate balance because you obviously have to be somewhat familiar with your client. You have to have a relationship with your client, but you shouldn't become so familiar with your client that you sort of think, this client couldn't possibly do anything wrong. So, and there might be a small element of familiarity threat, although I haven't actually mentioned the solution, but there might actually be that might arise to a small extent in the question that we're looking at. Again, the next slide looks at safeguards. Again, I'll leave you largely to look at that for yourself. But if you look just at some of them there, for example, documented policies regarding the need to identify threats to compliance with the fundamental principles, evaluating the significance of those threats, and applying safeguards to eliminate or reduce the threats to an acceptable level. That sort of thing is quite significant. But there's a lot there, and I'm not spending a lot of time on it There's a lot there, and it is very important for you, and it's very important for the exam. Also, then, it's important to be said that, there's two things here. There's independence of mind and independence in appearance, or what's sometimes called independence in fact and independence in appearance. Independence of mind, basically, it's what's in your mind. So it's the state of mind that permits the expression of a conclusion without being affected by influences that compromise professional judgment, thereby allowing an individual to act with integrity and to exercise objectivity and skepticism. Independence in appearance, well, all that's really saying is that you should avoid facts and circumstances that are so significant that a reasonable and informed third party would be likely to conclude, weighing all the specific facts and circumstances, that a firm or a member of an audit team's integrity, objectivity, or skepticism has been compromised. In other words, even if you think that even if you as a practitioner think that you are of an independent mind, it may be that actually you're not, and it may be, or it may be even if you are, that somebody else might think you weren't, and even that situation must be avoided. So, at the risk of sort of repeating what I've said before, the procedures that should be in place are to identify threats to independence, evaluate the significance of the threats identified, apply safeguards when necessary to eliminate the threats or reduce them to an acceptable level, or else, essentially, don't do the work. I mean, that's the nuclear option, but it is an option to which you would probably have to resort on some occasions. Now, in relation to audit and review engagements, the practitioner shall document conclusions regarding compliance with independence requirements and the substance of any relevant discussions to support those conclusions. Very important in an audit situation, and again, this kind of thing has come up in questions in the past, where you make a decision about this, that you document it. There's an audit standard on documentation, AIA 230. It's a very important standard in practice, because in practice there's a tendency to kind of do this or kind of do it in your head, but there is a danger of not actually writing it down, and it's a bit of a pain to have to write all these things down and date them and sign them and put them on the file and all of that. And at the time it seems kind of pointless, but I can absolutely tell you from experience that it is absolutely necessary, because 12 months later, if somebody asks you what you did or why you took a particular decision, you will not remember. Again, some of the things that you need to know here, just look, again, most of these are not particularly relevant to the question in hand. Basically, the kind of things we're talking about here, you shouldn't have a financial interest in a client whom you're auditing to make loans to or get loans from another client, unless those loans are in the normal course of business and so on. You shouldn't have a business relationship with your audit client, generally speaking, other than the relationship you have as auditor. You should avoid situations where you have a close family or personal relationship with an audit client. If you're employed by an audit client, you generally, and you then leave the audit client and you come to the auditor, you should generally avoid working on that client for at least 2 years. Sometimes auditors temporarily second staff to their client companies. That is not prohibited, but those staff should not subsequently be involved with the audit. It is absolutely prohibited to serve as a director or an officer of an audit client. There's lots of rules about long association of senior personnel with an audit client, including partner rotation. Normal rule there, the sort of general rule there, is that if you are doing the audit of what we call public interest entity, I'll explain in a minute what that is, but essentially it's a public company, then you should not be the audit partner for more than 5 consecutive years. And the last one is relevant, the provision of non-audit services to audit clients. And we will talk about that in more detail presently. For non-assurance services, again, there are various rules about this. The first one, they're preparing accounting records and financial statements for an audit client, generally prohibited for public interest entities. It's not prohibited, and in fact, no, it's not prohibited, but the practice is, I think I would say, ubiquitous for smaller clients. But it is prohibited for larger clients. So to our valuation services. Certain tax services, generally sort of non-routine or disputation, tax services involving an element of disputation or dispute would be prohibited. Internal audit services, again, they're not prohibited. They're prohibited in some regimes. So for American companies for whom the Sarbanes-Oxley Act applies, for example, they're prohibited, but they're not generally prohibited. IT system services, again, there's an issue here because the issue here is that the auditor is quite often involved in setting up. If the auditor is involved in setting up the IT system, then can the auditor objectively report on that system later on? And so on through them. The ones that are I suppose significant are, again, the relative size of fees. The ones that are, I suppose, relevant to this question are the relevant size of fees one, which is the fourth bullet point from the bottom, and the very first bullet point, which is the preparing of accounting records. Again, this slide is talking about the kind of things that you can do to help safeguard against any of those threats. So the sort of thing you're talking about there would be things like policies within the audit firm regarding the oversight and responsibility of the provision of non-assurance services. So, for example, if you are writing up the books of account or doing the bookkeeping for a company, and then you're subsequently doing the audit of that same company, that's not prohibited unless the company is a public interest entity. But if you are doing it, it might be a very good idea to have one partner, and in as much as is possible, one team of people involved in the writing up of the books of accounts and the preparation of the financial statements, and a different team of people involved in the audit. Or other things you might look at would be things like involving an additional practitioner to advise on the potential impact of the non-assurance engagement on the independence of the member of the audit team or the firm. That sort of thing is something that you could certainly consider. Obtaining the client's acknowledgement of responsibility for the results of the work performed by the firm. So, for example, if you do prepare financial statements, then you are doing so as an agent of the client. You're doing so, if you like, on the client's behalf, rather than doing so as an auditor. Now, okay, that's a slightly thin argument, but it might be worth getting the client, for example, to acknowledge that in writing. And the last one, they're making arrangements so that personnel providing non-audit services do not participate in the audit engagement. Again, that's in an ideal world. Mightn't always be possible with smaller practices or whatever, but it is something to aim for. Now, the next slide is absolutely crucial to the question we're going to look at. Preparing accounting records and financial statements. So the biggest single problem here with preparing the accounting records and the financial statements, aside the fact that it's just not allowed where you're talking about public interest entities, but absent that fact, assume we're not dealing with a public interest entity. What's the really important thing? Well, the really important thing is that you shall not assume a management responsibility. That you as the auditor don't do something, you don't take a decision that should properly be the decision of management to take. So, for example, originating or changing journal entries or determining the amount or classification of transactions. So, you shouldn't be, if you do make journal entries or whatever, adjusting the financial statements, you should absolutely have the explicit authority of management to do it. Nor should you prepare or change source documents or originating data in electronic or other form evidencing the occurrence of a transaction. Now, on the other hand, audit firms may provide assistance to management in preparing accounting records or financial statements, and you'll see when you come to the question that we're looking at that this question is in this question is in this grey area somewhere. Obviously, you're allowed to carry out activities considered a normal part of the audit process that do not threaten independence. You are also, and this is really probably the key to the question that we're going to look at, you are allowed to give technical assistance and advice on accounting and issues that generally do not threaten independence. So it's in there somewhere, and you'll see what I mean when we look at the question in a second. And again, services related to the preparation of accounting records and financial statements of a routine or mechanical nature are fine. And I suppose I should also have mentioned earlier there is a thing called, as well as what we call the self-interest threat, there is a thing called the self-review threat. And the self-review threat essentially arises from the fact that you may, as an auditor, end up reviewing something that you did yourself. So if you do something in terms of preparing the financial statement and then you audit it, well, clearly at least a risk, or at least a perception of a risk, that, because you did it yourself, you couldn't be described as auditing it properly. Just to talk about what this public interest entity means, I said we'd mention this, what this public interest entity thing meant. Look, essentially a public interest entity, I think for the purpose of the exam, it's a public company, a listed company is a public interest entity. I think for the purpose of the exam, if it's another entity, you're more or less going to have to be told that it's a public interest entity. The kind of things you might be talking about that would be public interest entities that would not be public companies would be probably things like large charities, maybe large sporting organizations, maybe entities like community-based banks or what we call in this part of the world credit unions, or they call them in some parts of the world savings and loan associations, kind of like community, like cooperative type banks, things like that. We saw, if you remember in a previous question, an entity was set up as a workers' co-op. Something like that might be considered to be a public interest entity. It's something where there's more than the normal level of public interest. But generally speaking, you're talking about public companies. Now, the next The next 8 slides I'm not going to spend much time on because again I've put them in for the sake of completeness, and so that when you come away from this webinar, you know, you can download them and you can read them, and they may well be something that comes up in the exam. They're not particularly relevant for what I'm doing here. So the first one is valuation services. This is where as an audit firm, you value something for the client. So you value buildings, or you value a pension fund or something like that. The problem with this is that a self-review threat may be created when a firm performs a valuation that is being incorporated into the client's financial statements. And even if not a self-review threat, maybe the perception of a self-review threat. So that's an issue with valuation. Taxation services, again, generally don't do for public interest entities. And the general idea with taxation services is that if it's something that's disputatious, if it's something that's there's a difficulty there's likely to be a difficulty between the client and the tax authorities, then you should avoid it. Internal audit services, it isn't uncommon It isn't uncommon for companies, for external auditors, to provide internal audit services for companies, but for public interest entities, audit clients are not allowed to provide internal audit services that relate to a significant part of the internal controls over financial reporting. Financial accounting systems that generate information that is separately or in the aggregate significant to the client's accounting records or financial statements. Again, I spoke a little bit earlier about IT systems services, and again, the problem here, we're coming back to this thing again of the self-review threat. You know, if you're the one that put in the IT system, can you really be expected to, you know, conclude 12 months later or 2 years later that it's not working properly? And that's the issue there. Litigation support services brings in a new one that I haven't mentioned to date, which is what's called the advocacy threat. Again, you see this coming up. In various questions. The advocacy threat is this idea that you, as an auditor, you'd be seen to be advocating for your client, or you'd be seen to be making your client's case, and you're not supposed to do that. You're supposed to be objective in relation to your client. Now, you know, when might that? The typical sort of example of why that might happen, might arise in practice, would be, you know, you've got a client who's trying to have their financial facilities with the bank extended, and they ask you as auditor to, you know, make some sort of submission to the bank on their behalf. Now, you have to be very careful in that situation. That, you know, if you do say anything, that anything you say is just a completely objective statement of fact, and that it's not, and that you're not seen as actually getting into the client's, you know, getting into what they call advocating for the client. Legal services, again, you get self-review and advocacy threats there. Recruiting services, you're getting into, if you help recruit for clients, it says that they are for public interest clients, audit clients with respect to recruiting directors or officers of an entity or senior management who will have a direct influence over the accounting records or the financial statements. The firm shall not search for or seek out candidates for such positions and undertake reference checks of prospective candidates, again, for fairly obvious reasons. And again, then, the next one is in relation to corporate financial services. And there's an element, I suppose, of this in the question that we're going to look at. Providing corporate financial services, again, can provide advocacy and self-review threats. So you can see again here, I'm not going to go, you can see here is a summary of prohibited interest and relationships for auditors of public interest entities. Now, be aware that these are only prohibited for public interest entities. They're not prohibited for other entities. But nevertheless, if you're carrying out some of these things for other entities, you should be aware that it may infringe on your independence. And it's something you have to consider. It doesn't mean you absolutely can't do it for non-public interest entities, but it does mean that you have to be careful about it. Again, on the next slide, we have prohibited non-audit services to the audit of public interest entities. And again, these are things you cannot do, or you're supposed not to do for public interest entities. And there's a couple of slides of them there. Again, they're not prohibited for non-public interest entities. Okay, so that is a real fast whistle-stop tour of the ethics rules. And maybe we're talking about the threats to independence. Again, you have the self-review threat, so you have the self-interest threat, the self-review threat, the familiarity threat, the advocacy threat, and the intimidation threats. Those are the 5 threats that the IEASB, the International Ethical Standards Board for Accountants, identifies as being the threats that auditors ought to be aware of. There is also, you will see in some textbooks, mention also of the management threat, which is the threat of taking management decisions. Now, that's not actually in the IESBA code, although it is in the APB code, which is the Auditing Practices Board, which is the UK and Ireland code. And it is, it is a real threat as well, although it's not specifically listed in the code, but you should be familiar with what those threats are and with what they mean. Now, that brings us to the second and quite different part of this, which is looking at IFRS 2 share-based payments. Now, this is quite a technical standard, and again, I'm not going to, in the whatever 10 or 10 minutes that I'm going to have to talk about it, I'm not going to be doing it justice. And again, in the sort of whatever number of slides you have there, maybe 20 slides or something that you have there, it's not really going to do it justice either. And certainly, if you're taking a financial accounting exam, you need to be going into this in a bit more detail. What I'm giving you is sort of an overview for what you would need to know from an auditing point of view. Just to give you a bit of a background to this, although it's not the case here, the background to this standard is that companies, most of the application of this standard, not in this case, but most of the application of this standard is related to remuneration. And this standard was made necessary because a number of years ago, it became very common for companies to offer some form of share options or shares as part of the remuneration package of particularly their senior executives. So the senior executives were given a number of, generally speaking, they were given an option to buy shares, or they were given some sort of, they were told that their salary would in some way be dependent upon or linked to the company's share price. And this was intended, in theory, this is good corporate governance because it's intended to promote goal congruence. Like, it's intended to promote a situation where the management of the company and the shareholders want the same thing, because both of them essentially want the share price to go up. Before the advent of IFRS 2, you had an anomalous situation where essentially shares were being issued, but there was no work was being done by these executives. Remuneration was being paid to them, but the remuneration wasn't being reflected anywhere in the let's call it the profit and loss account. It wasn't being deducted from profit. So essentially, that's what IFRS 2 was about. It was about capturing the cost to companies of making these share-based payments. So it was felt that relevant and faithfully represented financial information about an entity's share-based payment transactions is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. So the scope of IFRS 2, it applies to transactions in which shares or other equity instruments are issued in return for goods or services. Okay, now it brings in goods, and that's what's relevant here, for goods or services, usually applicable to employee share options, but it could be other things, but usually employee share options. The payment amount is based on the price of the entity's shares in some way, right? That's the point. That the amount that has to be paid, well, it's either the amount that's paid, either the person supplying the service or supplying the goods or the services, there are given shares in the company, so obviously, therefore, that's going to be dependent on the share price. So they're either given shares in the company, or they're given essentially cash based in some way on the share price. Now, the scope of IFRS 2 is broader than just employee share options, which is why it's relevant to this question. A couple of exceptions, worry too much about these, but basically it doesn't apply as IFRS 3 applies, which is part of a business combination or part of a joint venture, which is covered under IFRS 11, or it's a concerned with financial instruments, IAS 32 or 39. So if those standards apply, those standards sort of override this standard. The principle here is that a share-based payment transaction is recognized when the entity obtains the goods or services. And the goods or services are recognized as assets or expenses as appropriate, and the transaction is recognized in equity if equity settled or as a liability if cash settled. Basically, if they're issuing shares, you have to show the shares in the financial statements. If they're paying money based on the share price, you have to show the liability for the amount of money that is required to be paid. Couple of technical points. The grant date is the date at which the undertaking and another party agree to a share-based payment arrangement, being the undertaking, which is the body that would be issuing the shares, and the counterparty have agreed the terms and conditions. The measurement date for transaction with services other than staff and those providing similar services, the measurement date is the date the undertaking obtains the goods or the services, which is relevant to the question we're going to look at. And the vesting period is the period during which the specified vesting conditions of a share-based payment arrangement are to be satisfied. That's not particularly relevant for us in this instance, but this is relevant where you have options that carry on over a period of time. Okay, the principle here is that they're measured at fair value at the measurement date of the goods and services received, and for our purposes, that is the date the goods are received in terms of the question that we're going to look at. Now, if the fair value of the goods or services cannot be estimated reliably, the fair value of the equity instruments at the grant date is used. So if you can't work out the value of the services provided, then you use the value of the equity instruments. And for arrangements for employees, you must measure the fair value of the services with reference to the fair value of the instruments. So it's essentially the fair value of the instruments if you're dealing with employees. Now it's tricky because identifying share-based payment transactions may not always be straightforward. Distinguishing equity settlement and cash settlement may not be that easy. The plans may be difficult. The fair value of options, you may have to use various valuation models to come up with the fair value of options. Now, if you've done a lot of financial management, you'll have come across these things like the Black-Scholes model and so on. These are methods of working out the valuation of options and estimating vesting period conditions. Now, fortunately, in the question we're looking at, we don't really have any of that. We don't really have any of that, those complications. But I'm just letting you know that they're there. Now, the general recognition principles are that we recognize goods or services at the fair value when the goods or services are obtained or the services are received. When the goods or services, when the goods or services do not qualify for recognition of assets and expenses recognized, that's normally when you're dealing with like share options for employees and so on. For equity settled share-based payment transactions and a corresponding increase in equity, this is what we're going to be dealing with in the question we're going to look at. The entry would be to debit the property, plant and equipment account and credit equity. And for cash settlements, it would be debit property, plant and equipment and credit, current liabilities. Okay, we just have a quick look at an example here of this. An entity whose shares are not publicly traded entered into share-based payment transactions in 2001 or 2011 to 2013 as follows. So we just have three little examples of how what this would look like here. So on the 30th of January 2001, Entity M received marketing services in exchange for 400 of its shares. Entity M cannot determine directly the fair value of the marketing services received. The fair value of entity M's shares on the 30th of January was 26, the C used as currency units, could be any currency, 26, whatever they are, currency units per share. Now, what you're asked to do, what this question asks you to do, I'll just go over onto the next slide here, is to prepare the journal entries for those share-based transactions. Ignore the journal entries required in respect of the shares themselves, and assume that none of the employee compensation qualifies for capitalization. So just what would be the journal entry for that? So if we just have a look at that, the question there is 400 shares at 26 currency units per share. So if we just look at that, so it's debit for the first one there, it's debit so it's basically 26. So it's basically 400 per share by 26, which is 10,400. So debit profit and loss manufacturing expenses 10,400. Credit the equity 10,400 to recognise the receipt of marketing services in exchange for shares. Right, because the share-based payment vests at the grant date, the employees have an unconditional right to take no part of the rewards for future services. The fair value is measured at the fair value of the shares in exchange is the fair value of the shares. Sorry, we did the wrong one. Fair value, so it's 400 shares at 26 currency units per share, and that's your 10,400. If you just go back to the second one. Okay. So on the 31st of December, NCDM established a supplemental annual bonus plan for all employees who work for the company for the entire year. The intention was to make the bonus approximately equal to 1% of the total payroll, subject to issuing whole numbers of shares. So upon receipt of the shares, the employees had the immediate and unconditional right to sell the shares. They granted 3,000 shares under the plan. Management estimated that the fair value of the shares was 28 per share, and the payroll bonus was the pre-bonus payroll was 8.4 million. Again, it's quite simple. Very slight delay in these slides changing. Yeah, so here we go. The staff bonus, again, it's the 3,000 shares at 28 units, which is 84,000, and that's to recognise the receipt of employee services in respect of 3,000 entity M shares. And again, if you look back, that 84,000 is approximately equal to 1% of the total payroll, which was 8.4 million. So again, it's just debit to profit, and in this case, it's debit to profit and loss, credit equity, because it's essentially extra payments for the employees. Now, if we go back to number C here, on the 2nd of October, and this is actually the one most relevant to what we're going to look at, NCM purchased office equipment by issuing 4,000 of its ordinary shares. Selling price of the office equipment was 110,000. Management estimated that the fair value of the shares was 29 per share. Okay, so here what we have is, here what we do is we put it in at the fair value. Okay, so we debit the property, plant and equipment, 110,000, as if we had bought the property, plant and equipment for cash, and we credit equity of 110,000 to recognise receipt in exchange for the 4,000 entity M shares. The normal selling price, assuming the purchases from an independent vendor, is the best measurement of the fair value of the equipment received, and that's what IFRS 2 says. So in the first instance, you look to that in IFRS 2. NTM could measure the fair value of the equipment as the fair value of the shares granted in exchange for the equipment, which is 4,000 by 129, only if the fair value cannot be estimated reliably. So in this case, the fair value can be estimated reliably. It is 110,000, so we can put it in as 110,000. We could use the 116,000 if we had no other way of valuing the property, plant and equipment. Now, obviously, if there was there isn't much difference there. The difference is 6,000. The difference there of about 5% between one and the other, which is probably okay in terms of the fact that it wouldn't be material. If there was a very material difference between the two, then obviously as an auditor you'd have a problem, because that would suggest that there was something odd going on. But there's nothing there in that. So just to make that point a bit further, the valuation methods that can be used are not specified in Section 26. This is of IFRS 2. In the absence of an observable market price, the entity's directors must use such entity-specific observable market data, such as a recent sale of the shares by one of the entity's shareholders, if available. If such information is not available, the entity directors must use judgment to apply the most appropriate valuation method to determine the fair value of the equity instruments. And there is some more guidance there in relation to smaller entities. The fair value of the unquoted equity instruments may be determined by estimating the fair value of the business. Often the value attributable to the equity holders is derived indirectly by valuing the business funded by all the capital providers, both debt and equity, and then deducting from this the fair value of the debt to give the fair value of the equity. And you can do that using either a market approach, an income approach, or an adjusted present value approach. What they're saying there is that if you're issuing, as we are in the question that we're looking at here, if we're issuing shares in a non-quoted company, by definition, there won't, because the company is unquoted, there won't be a share price for those shares. So how do you go about estimating them? And all they're saying here is that one way of going about estimating it is to estimate the value of the business as a whole, and then say, well, okay, the business is worth, 100 million as a whole. It's got debt of 30 million. So the equity stake, the equity is worth 70 million. And we're issuing 10% of the equity. So the 10% of the equity is worth 7 million. That's what they're saying that you can do. And you'll see the relevance of that. Okay, so would you, we might just pause for a few minutes and have a look now at the question. There's two bits to it. First part is to advise the partners on the independence issue, and the second about the work that should be undertaken in respect of IFRS 2. But maybe you should go ahead now and have a look at the question, Harvey. I'll just stop talking for 3 or 4 minutes. Obviously, if there's any questions, you can either ask me by your microphone or send them to me. Or obviously, if you have any questions afterwards, you can send them to the address mentioned at the front there, chief@aiworldwide.com. So we just pause for a few minutes at that, and I'll just let you have a read on the question.
As I said before, if anyone needs to download the question, you can. I've just posted it there in the chat box. So if you want to download that, it's just a PDF file. Take a look and see what you think.
Okay, well, we'll maybe carry on. We'll just talk about the question for a few minutes. You're told in the first sentence of the question that Harvey is the firm's largest audit client and obtains 5% of its gross recurring fee income from the Harvey audit. So, when you see that, you should immediately be thinking about things like self-interest threat, level of fees, that sort of thing. You're told that Harvey owns and operates a small fleet of deep-sea trawlers. The directors have decided to expand the fleet by having the Lucky Mascot shipyard build a new trawler to Harvey's specifications. And Harvey has agreed to pay for the transaction by an exchange of shares. Somewhat unusual, but there you go. You're told the Lucky Mascot shipyard has agreed to accept a block of shares that will give the company a 15% stake in Harvey. So that's what they're doing. You're told that Lucky Mascot has no other relationship with Harvey, so it's their auditor. It doesn't do anything else. You're told it's a well-established company. It builds ships to order for a range of customers. Each ship is cost on the basis of materials and labour, and selling prices determined by negotiation. So, what you're being told there, you're told again it will take several months of planning and so on. What you're really told there is that there's not a very open market in these kind of ships. This isn't like deciding that you want to buy a new car and sort of being able to ring up the dealers and saying, how much is a certain type of car, and being fairly certain that you're going to get the same answer, more or less, no matter what deal you rig. There simply isn't a market in these things. There isn't that open a market in these things. Second thing then is that, or the next sentence is that the directors of Harvey have approached the audit firm to ask for professional support for the forthcoming acquisition of the new trawler. Harvey's accountants, in studying the requirements of IFRS 2, and has determined that the trawler should be accounted for on the basis of the fair value of either the trawler itself or the fair value of the shares that receive, which is perfectly correct. And it should, in as much as is possible, like I've just said, like the example we just looked at, it should be the fair value of the trawler itself, if we can establish that. The chief accountant is unsure how to arrive at each of these figures, and Harvey's directors have asked the partner in charge of their external audit to arrange some accountancy support to assist with this exercise. So, immediately you're into the provision of non-assurance services, the provision of non-audit services. The request has posed a dilemma for the audit firm's managing partner, because the firm has always had a policy of providing its audit clients with little or nothing in the way of non-audit services, and that is a very commendable policy. And, in many ways, there are many arguments that could be put forward for why it's better to have that policy. However, it would generate substantial consultancy fees. Now, again, when you see that, you should be thinking, well, they're on 5% already, plus the potential consultancy fees, which could be as high as the audit fee. So you're talking about consultancy fees here of 5% plus potentially another 5%. Harvey's directors have stated that they are keen to have the work done with their external auditor because they wish to do it with an accountancy firm that is familiar with their circumstances, which from their point of view, is perfectly reasonable. If the firm does not agree to undertake the consultancy, then Harvey will consider appointing a new auditor who will also provide the professional services. Now, is there a little hint of, an intimidation threat there, for example? I didn't put that in the answer, but probably is something you could be thinking about. Is that a little bit maybe of an intimidation threat? So the managing partner has called a meeting of the firm's audit partners to discuss the proposal. Harvey's not a quoted company. The audit firm is a single office with 7 partners and 40 professional staff. Significance of that, I suppose, is that for a larger accountancy, the larger the auditing practice, the more easy it is for them to get independent partners and independent members of staff. Because, you could always have this done, out of a different office. And if you had a really large accounting office, and there was a really large client and they wanted some work done like that, if the London office were to ask the New York office to do it for them, there would potentially be a greater degree of independence there, whereas in this case, there's only 7 partners, there's only 40 staff, they all work in the same building, So how independent from one another can they be? So, okay, so what are the points to be making then as part of the solution? Well, the first thing is, Harvey is a substantial client whose fee income is at least a potential threat to independence. Now, you might remember I said, although I don't think it's written down anywhere, but I said at the start, the sort of benchmark that's used is 15%. Now, that's only a guideline, and it's not to be taken as, it's not to be taken as 14.9% is all right and 15.1% can't do it. But the sort of general guideline is 15% taking 1 year with another. In this case, it's 5 plus consultancy work potentially another 5. Only adds to 10, obviously. So arguably, 10 is clearly 10 is less than 15, and arguably it's sufficiently less than 15 not to be an infringement of the rules. The additional proposed non-assurance services request make it even more so. Obviously, yes, they make it even more so in terms of making it even more of a threat to independence. Then there's also the question of whether the provision of the additional services per se, so whether actually providing the additional services or the additional services that they're providing is itself a threat to independence, because it is something that is very closely related to the preparation of the financial statements. It's very close to, arguably it almost is a preparation of the financial statements. And also, there can be very little doubt that the transaction will have a material impact on Harvey's financial statements, because you're told that Lucky.com will get 15% of Harvey's shares. So there's very little doubt that it will have it is a material transaction. Now, on the other hand, well, let's see what's on the other hand in a second. So on the other hand, 5%, 5% is not a particularly high proportion of the gross recurring practice income. Now, this is the phrase that's used: gross recurring practice fee income. So it's the total fee income from all sources, but they also talk about recurring. Now, this won't presumably this won't recur, or there's no suggestion this is going to recur. So. Again, 5% not a particularly high proportion, and if you were operating over here in Ireland or in the UK, the proportion is 15%. And I'm just sort of saying that by way of kind of, you can sort of put that in as a kind of benchmark. It doesn't have any particular standing outside of the UK or Ireland, but it's a sort of benchmark that could be looked at. Clearly, there's no suggestion that Harvey's a public interest entity. We're told, very explicitly told in the second last line of the question, Harvey is not a quoted company. And there's no suggestion that there's anything about Harvey that would mean that there was any particular public interest in it. So it's not a public interest entity. The proposed exercise on fair value is presumably a once-off. There's no suggestion that this is going to be repeated. So again, it's a once-off. Another interesting point here is that there's nothing suspicious, particularly, about Harvey not having the expertise to complete the exercise, nor is there any suggestion that Harvey wanted the transaction to be presented anything other than fair, in any way other than fairly, right? So there's nothing in this, Harvey doesn't have, presumably Harvey it owns and operates a fleet of deep sea trawlers. There's no particular reason to expect or to think that Harvey should have any particular expertise in the valuation of shares. Maybe some in the valuation of the trawlers themselves, but in terms of financial instruments and so on, Harvey's not a large bank or something that you would expect to have considerable in-house expertise. You would not expect a company whose expertise is in deep sea fishing to know very much about this sort of stuff. So it is quite plausible when they say that they don't have any expertise to complete the exercise. And again, there's nothing here to suggest, there's nothing in the question. Now, this is, of course, one of these situations where, in reality, you'd have a much better idea than you do in the exam question. But there's nothing in the exam question to suggest that there's anything untoward going on here. This company is quite sort of above board. No pun intended. They're quite. There's no suggestion that they want you to value it in any particular way. They're just asking you to know what you do it. And there's also a point that you could make that being involved may actually help the auditor's knowledge and understanding of the business. So this gives the auditor, in some ways, an insight into the business. So there may actually be positive benefits. I think ultimately this one comes down to this. It comes down to a question of the extent to which the exercise can be considered a routine calculation, or whether it is a highly judgmental exercise, inevitably involving the making of subjective decisions which are properly in the remit of management. I think that is essentially maybe the issue, right? Now, there is another thing that I didn't mention, and it only occurred to me as I was talking, and I didn't mention it on the slides, and it isn't mentioned in the examiner solution either, but there is a bit here of a self-review threat arising. If we do this, we're going to be doing the calculation and we're going to be auditing it. So there is an issue around, are we in a position, for example, to get maybe one partner and maybe some members of staff to do this calculation, maybe the partner who does this calculation of fair values or does the investigation into the fair values, maybe that should be a partner that's not involved in the audit, has never had any involvement in the audit, knows nothing about it. There are 7 partners there. Okay, this is the firm's largest client, but there's probably 1 or 2 of them that have never had any involvement with this client. And if there is, well, maybe they're the ones to get to do this exercise, so as to minimise the self-review threat. Now, I didn't actually think of that until this second, but I think that is a point that is worth making. Now, in relation to number B, then, number B says recommend stating reasons that the work should be undertaken by the audit firm to assist Harvey with the application of the transaction. So, in other words, what work would you need to do? And this is where you kind of need to know your IFRS 2 to actually know about it. So, ideally, the fair value of the trawler should be determined. If this can be done, the following journal entry should be used to record the transaction. So, it should be debit property, plant and equipment, credit the ordinary share capital, and then, depending on the number of ordinary shares issued and depending on the valuation of those ordinary shares, you may have a share premium to put in. So it's debit. So that's what you want to do. You want to establish the value of the property, plant and equipment. You'll know how many shares were issued. You'll need to work out a valuation for the shares. And the difference between the nominal value of the ordinary shares issued and the value of the property, plant and equipment will go into the share premium. Will go into the share premium account. So how would you actually do that? Well, it's mundane enough actually as to how you would do it, because the first thing you would have to do is to try and work out the fair value of the shares. So how would you do that? Well, the obvious, and again, with auditing, do the obvious thing first. And the obvious first thing would be contact Lucky Mascot and ask them to confirm the normal cash price for similar trawler. You have no association with Lucky Mascot. You've no relationship with Lucky Mascot. So Lucky Mascot, as far as you're concerned, are an independent company. If you can get them to tell you, preferably in writing, obviously with the permission of Harvey, but if you can get them to tell you in writing, that's very good audit evidence, because especially if they tell you in writing directly, then you've got written independent evidence from a presumably reliable third party. That's very good evidence. So if you can do that, and they can obviously send that to you completely in confidence. So if they can do that and they confirm the normal cash price of the trawler or similar trawler, well, sure, that's pretty much became certain match. Examine if for some reason you can't do that, or additionally, I suppose, if you want to do that, you might want to look at the correspondence between Lucky Mascot and Harvey for the evidence of normal price, because obviously there was some correspondence about this. There was obviously plans and so on going hither and thither. There was presumably some sort of costing exercise done. Have a look at there, see what's there. You might study the financial accounts of similar companies to establish the cost of their trawlers. Again, a bit hard to know what's available. It might be a somewhat inexact exercise, but it's worth having a look. Clearly, there are other companies that have trawlers. What are they valued at in the financial statements? And then you might have a look at things like trade journals, internet sites, and so on. Presumably there are other companies that would, there are other, for example, shipyards that would be prepared to build these trawlers, that would be tendering for them, that kind of thing. So have a look on the internet, have a look in trade journals, that kind of thing. See if you can find out something that way. So that's on the one hand, that's on the fair value of the shares. On the other hand, you should consider, that's the value of the trawler, the share value of the shares. Well, for them, there might be a quoted company in the same industry that offers some relevant statistics that can be used for valuation purposes. For example, the auditor could take a quoted company's price earnings ratio and apply that to Harvey's earnings in order to estimate a valuation for Harvey. So if you can find another company, let's say it's got a price earnings ratio of 10, for the argument, then you look at Harvey's profit, then you multiply it by 10, and that gives you a ballpark valuation for Harvey. You would, of course, be hoping that the fair value of the shares would be reasonably similar to the share value of the trawler. This is something like the other example that we saw earlier. Obviously, if there's a very big difference, you'd be wondering what's going on, because if there's a very big difference, why would Lucky Mascot be agreeing to do this for 15% of Harvey's shares if that's worth a lot less than the value of the trawler, or why would Harvey be agreeing to it if it's a lot more than the value of the trawler? So you would want to see that they were reasonably similar. In the event of a material disparity, the auditors should reconfirm their calculation. So you would obviously go back and have a look again if there was a very material disparity. But if necessary, greater weight should be given to the value of the trawler, because IFRS 2 requires that the fair value of the asset be used and the fair value of the shares are to be substituted only if the value of the asset cannot be established. And I don't think really, it shouldn't be that difficult to value the trawler. I mean, it's not a terribly esoteric type of asset. It should be capable of valuing it with reasonable certainty. So that's it. As I say, I think that was probably a question that would have, when you see the answer, when you see it laid out like that, and you can read the examiner's answer in your spare time, it isn't, the examiner's answer isn't really any different to mine. It isn't materially different. Actually, when you look at it, it's one of these questions where you look at it and you sort of go, oh, that was easy enough. But I think people might have been actually put off by the question and by the way that various different things were combined in the question, which was quite unusual. So I hope you found that useful. Obviously, if you have any questions, you can ping me now, or you can email me. You can email me later.
Okay, everyone. Thanks to Gerard there for that session. I've just posted a download link there to the slides that Gerard was going through today. If anyone wants to download them now, I'll also be including them in a follow-up email to this session that will include the slides, the question, the solution, and a link to a recording of this webinar. As Gerard said, if you have any questions, we're going to remain here now for a few minutes. So please do type them in the chat box, and we'll get to you. Thanks. Okay, it seems like nobody has any questions. So if you think of any after we've gone, please forward them to my email address, which is achieve@aiaworldwide.com. I can pass them on to Gerard and he'll respond to you. I hope you've enjoyed today's session. I think it was very, very useful. And if you are able to join us for the next webinar, that will be in 2 weeks' time. I will be emailing you about that. But thank you for attending and have a good weekend.
Thank you, everybody, and good afternoon or good evening.